Mortgage points, what the heck are they? Also known as discount points. And is it a right situation for you when buying a home? And there are a lot of different factors to consider, and that's what today's topic is all about. But first, my name is Josh Parker, your Austin realtor, born and raised in this great city of Austin, Texas. And if this is your first time here, do me a huge favor, hit that subscribe button and follow along. So what exactly is a mortgage point, or sometimes called a discount point? Well, it is a fee that you pay up front in order to lower your interest rate. As we all know, anytime you get a loan, you are going to pay interest for somebody loaning you that money. And depending on your credit worthiness, it will determine your rate. And so this is an option for you to buy down that rate and get it even lower than what you originally were determined that you could get. Now, let's take an easy example. Discount points often cost 1% of the home loan. So for this example, if we take a $100,000 home loan, 1 point will cost you $1,000. Now, when I say 1 point, that doesn't necessarily mean 1 percentage. Typically speaking, it is 0.25% of an interest rate for every point that you purchase. And lenders have a cap on these interest rate reductions or points. And so depending on how many points that you want to purchase up front will determine the interest rate that you can buy it down to. So let's look at another example. Let's say that you have a $200,000 loan, and remember, your points are 1%. So in this case, it would be $2,000 per point. And you want to buy a rate of 4.75 from the original rate that the bank gave you of 5.125. So that means that in order to buy that 1.75 mortgage point rate buy down, it will cost you an additional $3,500 that you will pay at closing. Now let's look at the two scenarios because it can play a huge factor in determining whether or not it's a right fit for you. So let's say that you didn't want to buy points and you wanted to stay with that 5.125 over the course of 30-year note, and you didn't make a single extra payment, you will end up paying about $391,000. Now, if you decide, hey, I want to spend that $3,500 up front to get that lower rate, and so now you have a rate of 4.75 over that same course of 30 years, not making an extra payment, you will end up paying $375,000, which is a savings of about $16,000 over the course of the 30 years. Now, why is that beneficial? Well, I don't know about you, but I like to keep my money. And so the more money I can keep, the better off I am. Now, it doesn't work for every scenario, and we'll get into that shortly. But let's talk about some of the benefits. Well, the obvious, it saves you money. So spending a little upfront will save you a lot in the long term. It will also lower your payment. And so maybe it allows you to afford a little more house if that's what you want to do. And it can also save you on some taxes. Now, I am not a CPA, but because it is considered a prepaid mortgage, you are able to deduct the cost of the points on your taxes. Now, confirm that with your CPA, but we've seen it in the past. So, should you buy mortgage points? That is the big question because it does not work for everybody. Let's say you want to stay in your home for a long time. The longer you stay in your home, the more it makes sense to buy the rate down. You've also determined what the break-even point is. And we're going to run through that. I'll put it up on the screen here. But let's say you have a $200,000 loan amount and you're going from 5.125 to a 4.75. That saves you about $46 a month on your loan. And as I mentioned earlier, it is also going to save you about $16,000 over the life of the loan. So, as mentioned, you do that, your cost to purchase those discount points cost you $3,500. If you divide the upfront cost amount by your monthly savings, you'll find out that the break-even point is about 76 months, which is roughly 6 years. So if you plan on staying on your house for 6 years, then obviously it would make sense. Now let's discuss that a little deeper, because in today's market, it could be a very different scenario. And so you may not need to be in there for a total of 6 years in order for it to make sense. Yes, you still need to be in there for a certain amount of time, but let's say right now, because interest rates are so high and much higher than they were for the last 2 years, that you bought a house now, you paid for buydown rates, or the seller, which we're seeing oftentimes in this market, the seller is offering to pay for some rate buydown. And so that to me is a no-brainer if the seller is offering it up front to go ahead and take those. But there is still a break-even point. Now let's say 6 months, 8 months, a year down the road, the Fed decides to finally lower that rate again and you go refinance. Well, depending on how much lower it is, it may still make sense depending on how much money you're saving up front and how much your monthly payment is. So, that's the good. Now let's talk about the bad. When shouldn't you buy mortgage rate down points? Let's say you don't plan on staying in the home for very long, maybe a year, maybe 2 tops. It probably doesn't make a whole lot of sense to you, because you're not going to get the benefit of saving that long-term money that you would if you were staying 5, 6, 7 plus years. Now, the average home person stays in their home 5 to 7 years, especially these days. And so that's why I wanted to discuss this, because it is something that's valid for 85% of the people out there. Let's say you plan to pay extra on your mortgage payments. Well, mortgage points will only benefit you if you pay on your home loan for a long time, which means if you pay off your loan quickly, you might not end up saving as much money. As I said, if you're paying $3,500 out, you want to look at where that break-even point is at the back end of it so that you're not losing money. You don't have the money to buy down points. It's not worth emptying your savings account to save on interest down the line. Instead, you could save on interest in the long run by putting extra money towards your principal when you have the extra cash. Don't drain your savings and not have any reserves in the bank, because look guys, when you own a home, things do happen, things go wrong, and you have to repair them being a homeowner. Your down payment would suffer. It's usually better to apply the extra cash to your down payment than to points, because a larger down payment could mean a lower interest rate depending on the scenario. So, bottom line, though mortgage points are prepaid interest and they're right for some buyers, they don't always make financial sense for everybody. And we've gone over both scenarios, and so I really hope that this has helped. If you have questions on it, reach out to me. And like I said, we are seeing it so often in today's market where sellers are offering that. And if it doesn't work for your scenario, we can ask for that to go towards down payment or closing costs. So you have options out there, but this is just one of them. Hope this helps. Hope you all have a great day. Again, do me a favor, hit that subscribe button, and we'll see y'all soon.